Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be analyzing Autozone stock. This one came in by request down in the comment section of one of my other videos. If you have a request of a stock you would like me to take a look at on the channel, just put it down in the comments. I'll put the ticker on the whiteboard behind me and eventually I'll make a video. If it's a stock that's in the S&P 500 like Autozone, I post those on YouTube for free. The rest I post over on Patreon, which is at the $5 a month tier level. And if you join over on Patreon at that tier level, you can also get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. And I'll have those links down in the description. I'll also have a link for 25% off of Fast Graphs, which you'll see me using here in this video. So if you're ever interested in checking out Fast Graphs, I think they have a free trial period that you can use there too. Just use that link and you should be able to get 25% off your Fast Graphs subscription if you haven't ever used it before. All right. As always, this is not individual investing advice. This is just how I analyze stocks. So Autozone. So this is a good one. I'm glad somebody asked me about this because it's been one of my more successful investments. We bought this in the full Cyclical Investors Club service back pretty much right at the bottom of the March COVID crash. And I think it should be up over about 300%, give or take. And so it's done really well. It's basically kind of become a long-term hold in my portfolio. So I'm still long this one. I only check it during my regular kind of quarterly updates. And I haven't been following it too quickly, or too closely, because it's basically a long-term investment at this point. But I can analyze that as a new stock, and I do keep the track of the metrics and everything in my spreadsheet. So let's take it. I also kind of have a pretty good understanding, I think, of the macroeconomic situation that's going on. So first, when we look at Autozone, it has a beautiful long-term earnings growth chart. But what I would say is, let's shorten this fast graph real quick here. Let's bring it to this year's forward earnings. And I think this looks like it starts back in like 2004. So fast graphs, if you measure from this point back here to next year's earnings, or this year's earnings for them now, which is only a couple months, looks like they've had a 17.3% earnings per share growth, which is phenomenal. But not the main reason, but a big part of the reason for that earnings per share growth is because they bought back like a ton of shares. I didn't double check to see how much they had actually bought back, but it's something like 50% of the company or something over this time. It's a lot of shares. So they don't pay a dividend, and instead what they do is they basically take the money that they would normally spend on dividend and they just buy back the shares, which is, as long as the business is growing at a decent rate without those share buybacks, then that is usually a pretty decent way to spend capital. Now, there may reach a point where their growth slows, and then maybe it won't be such a good idea if they continue to buy back these shares. But during this growth period, it's been really nice for everybody involved. You don't have to pay taxes on your dividends that you get sent, whether you want them or not. That money gets automatically pretty much reinvested back in Autozone, and then they have some flexibility as to how much they want to buy back at any given time. Or in the U.S., dividend fluctuations are frowned upon more so than in other parts of the world. So when I calculate, let's get this to a shorter time period here. So looking more recently, still earnings growth for these guys is about the same, close to 17%. And very steady, no down years, no like negative years. Slowest year was 2016/17. When I take into account these buybacks, I think I started in 2015, which they're exactly the same growth as 2014. So, but when I take into account the buybacks, I get an earnings growth rate of just under 10%. So I use a more conservative earnings growth rate than you'll see on the fast graph. That's more close to 17, which adds up a lot. There's a big difference between 10 and I think it's a little under 10 and 17 over time. So when I do my valuation, it's going to be much more conservative. If you have a 19 PE or maybe a 20-ish PE that's growing at 17%, well, that looks like a fantastic buy. Nearly a PEG ratio of 1. So on any kind of dip, like right here, you're dipping almost down to that growth rate, the stock would be a buy. And the market basically has been coming in and buying it. There's a little bit bigger dip. So you can see that it was really a fantastic opportunity. Here, even with a 10% growth rate, it fell down to like a 10 PE. That PEG ratio of 1 is about when I bought it during the March 2020 crash. So I'll get into run the numbers here in a second. But the bigger picture here, I think, is just that, and this can all be said of O'Reilly as well. I just missed buying O'Reilly. I think it was the next closest stock on my spreadsheet to buy when the market bottomed. And if you look at O'Reilly, they have a similar dividend policy. They don't pay a dividend. They buy back their stock instead. And they've been executing similarly, even a little bit better, according to this earnings growth rate, than Autozone. So now, if you look at Advanced Auto Parts, which I warned investors about a while back, they have not been so successful. They do spend a lot of their money on a dividend. Historically, they might have lowered it. Let's look. Yeah, see, they lowered it. So, but during this, they didn't really raise it during this time because they weren't really growing. You can just see the difference. So this is one of the downsides sometimes, I think, of paying that dividend. If they would have reinvested in their business more, had better management, there's probably no reason they couldn't have done it similarly to O'Reilly and AutoZone. But instead, they really struggled to grow, and now they're shrinking, and the stock has been, I'm glad the thing is, like, these numbers didn't really look particularly bad for these guys. And I have a whole video on this somewhere from last fall. Maybe sooner than that. I think I did it before the majority of this decline. But if you looked at like the revenue trend, and then you could kind of see that something wasn't adding up, like something wasn't right. And then eventually we saw earnings fall off a cliff, and then the stock fell off a cliff, and then the dividend got cut. They're probably getting kicked out of the S&P 500 if they haven't already. So you have these three stocks. I did pretty good picking one at the bottom, almost getting the other one, and then also avoiding the worst one. So that, I like it. I like it when that happens and I actually get things right. So where was I? Yeah, the macro situation is I don't have a chart for this, but there just aren't as many new automobiles being sold, period. There haven't been for the past several years. Part of that had to do with COVID and chip problems. But I think the other part is just the auto manufacturers, would rather sell fewer cars and charge people more money for them. Stretch out financing, do all the things that people do to stretch for a new car. And what that has done is, especially now when kind of COVID stimulus money and stuff has run out, especially on medium and lower income families, is you get into a situation where the market for the people that can buy new cars are mostly those people that can kind of pay cash, and the used market is pretty much where everyone has to operate. Also, cars last longer than they used to, and the average car on the road I saw was 12 or 13. I think it's up to 13 years old now. So when you put all these things together, and then you also say, well, we have inflation that's gone up, especially for labor. So when you go to take your car to get worked on somewhere, it's going to cost you extra money. There's an extra incentive to, if you can, to do some of that work yourself. So all that, I think, benefits AutoZone. And just because there's more used cars, there's older cars, there's YouTube now, people are more willing to do work. You can buy a little scanning tool and figure out what the main issue often with your car is. And sometimes it's something simple you can just fix yourself. So All those things are kind of conspiring, I think, to help the auto parts retail stores, and as long as they're run well, like O'Reilly and AutoZone are. So I would have actually expected this earnings trend to kind of level off a little sooner than it has. I wouldn't be surprised if earnings growth slows or even dips a year or something in the next couple of years, because everything's kind of slowing down. I mean, they've grown earnings 100%, earnings per share 100% in 4 years. So it wouldn't surprise me if they level off and flatten off for a while and the stock price comes down a little bit. But those bigger dynamics, it's just hard for me to see. Now, if interest rates went back down close to zero or a little above zero for a while, and people had a chance to pay off their 96-month car payment, car loan terms and things, then you could see more new cars being sold. Maybe if they start making cheaper new cars, which automakers have been reluctant to do. I've been in the market for a car for 3 years now and been refusing to buy one. I finally just bought a used car. The price was fair. It wasn't cheap. It wasn't anything close to what I would have paid, and not just in absolute terms, but even inflation adjusted. Let's see. I bought my previous car before that in early 2019. I would say this is, even with inflation, at least it was still 20 to 30% more probably than what I was paying back then. So used car prices are still a little bit inflated, but they're coming down. New car prices have been pretty sticky. There's some more dealer incentives that are coming to try to move some of those, but the problem is there's just not any more extra new cars really being put on the road, and it's been that way for quite a few years now. So just the general macro situation sets up pretty well for AutoZone. So let's get into the numbers here. So again, I have almost a 10% earnings growth rate after I control for those buybacks. And then, so if we do that, if we take that, and I don't think they have much in the way of a debt adjustment, just a tiny bit, 20%. So in order to do that, I look at I last updated this in May, but so they have a $50 billion market cap. Total enterprise value is $62 billion. I just look at the difference between those, like how much higher the total enterprise value is than market cap. I add that to the stock price to account for if you were going to buy the whole company and whatever these obligations are. There's probably like rent and lease obligations and stuff built into some of this too, which is why the long-term debt and so forth is kind of super high. So you can kind of make your own judgment, but I accounted for that difference in the valuation. So instead of a $2,900 stock price, I treated it like it was $3,500. So that makes it a little bit more conservative. Yeah, so a normal PE without that adjustment is about 19. With that adjustment, like 20% more, so maybe more like 24 probably. But the earnings yield would be 4.26%. So earnings over price instead of PE. So you invert that, gives you this handy earnings yield. So what I do is I take the earnings yield. I assume I buy the whole business for $100. And if I did that and I own the whole business, it would produce $4.26 of earnings that I could keep for myself as the owner of the business. I want to know how fast that would grow over time and accumulate on my $100 investment. So I pull the first year growth forward. So 426, add almost 10%, 9 point whatever. And I would earn $4.69 on my $100. I want to take this 10 years into the future. And so I would collect about $74 on my $100 investment. If I plug that into a CAGR calculator, I get a 10-year earnings CAGR of 5.72%. Pretty similar to the rest of the market. Maybe slightly cheaper than some of the big tech stocks right now. But on average, in the range of the S&P 500. So on a relative basis, it's probably fairly valued. If this was 6.5, that's generally my midpoint of fair value. So a little more expensive than standard, fair value. But if I wouldn't consider selling it unless it was under 5, and probably significantly under 5, given everything else that's kind of the tailwind in their favor. So that would make it a hold for me. So I'm holding it, right? So if you want to buy it with new money, if you want to be conservative, if you think there might be a recession, or maybe that their earnings growth kind of dips for a year or levels off for a couple of years, and then the market kind of pulls in that valuation, like 50% lower would be the recession buy price. And then if you just wanted to get it at a fair price with a margin of safety, then about 35% lower, $1,870 would be where I would be aiming to buy it again. I believe when I bought it the first time, I was using a type of recession buy price similar to this. We can go back and look how far it fell off its high. So it was trading a little bit cheaper going into the March 2020 crash, COVID crash, than it is now. And this is approximate, right? So yeah, I probably did, this is like 40%, but from peak to trough to absolute intraday trough, I probably bought this one 50% off its highs. So it does happen. It can happen. I would have based this off of the 2008 recession. So let's go see. Now it doesn't mean it had to fall 50% off its high, but we can see how it did. This is actually relative to earnings. Yeah, so it didn't fall quite so much, but it only started that downturn at a 16 PE, and it grew 18% and 17% in the middle of the Great Recession. So yeah, not very many businesses did that, and it started off cheap basically, or at least fairly valued at the time, or not expensive with a 16 PE. So I think now it's a little more expensive, and therefore it could fall a little bit more. This little period here was interesting. This was when everybody got paranoid. Amazon, I didn't own it then. Amazon was going to take over the auto parts business, and it had another like 40% decline. So you can get these opportunities that come along in that 35%. It's not right at its high now, so it would actually be a little bit deeper off the peak, but it kind of had a pretty nifty peak here at 22 times earnings. What was it back here? 20, 21. So yeah, like 30% lower, 35% lower from here to 50% lower from here is where I would aim to buy. And the thing is, like, if you buy it at a low enough, if you get it at one of those low buy prices like I did, this is one where if you really get it cheap, you can just hold on to it, and you don't even really have to look at it again. And it's up, 300%. And even if it grows a little bit slower here, even if it grows at 9% or 8% or 7%, that's still going to be pretty easy, good, tax-free growth that you're going to be able to get until something really changes in the auto parts business. All right, hopefully you found this useful. If you did, hit the subscribe button. If you have a request, put it down in the comments section and like the video, and I'll see everybody later. Bye.